Well, welcome everyone. For those who are in Southeast Asia, those who are in Africa, good morning over to you. For those who are in the US, I hope that you guys have a wonderful dinner. Bob, thank you so much for joining us as well too. I know you mentioned that today is Christian Day because you've had a lot of board meetings today. And so here you are wrapping the night by sitting down and talking with us about your 10 predictions, economic predictions for 2021. Hey, welcome everyone. My name is Tommy Lee. I wear many different hats. I'm the executive director of the Growth Center for Church and Mission. I get a chance to work as the founder and president of Resource Global, and I get also a chance to work as the managing director of Together LA. My dear friend is Bob Dull, senior portfolio manager, chief equity strategist at Nuveen Investments. Bob manages 7 portfolios, including large caps and alternatives. But one of the things I would probably say, just a wonderful Christian business leader, marketplace leader, who has taught me so much about what it means to be a Christ follower in the business world. Bob is a mentor. He is a dear friend for over 10 years. And Bob, what an honor it is. And so I know a lot of times you've been busy. And so I'm going to bring you to the screen. How are you, Bob?
Good, my friend. Glad to be inside where it's not snowing.
Yeah. Well, for everyone, Bob is actually going to speak for about 30 minutes and give his. So, I mean, Bob, how many years have you been doing these 10 predictions?
We've lost count. Over 30, Tommy.
Yeah. From your days in Nuveen, I mean, your days at BlackRock or even Merrill Lynch, right?
And before that, I started the Oppenheimer Funds.
You got it. So Bob will be teaching for about, or just presenting for about 30 minutes. And then from that point on, we're going to actually make it Q&A. So if you have your chat section, you have my mobile, you have my WhatsApp, send in all your questions. I actually begin to see different questions coming my way. So please send in your different questions and then we'll throw it over to Bob. And other than that, we will make sure that your, besides Bob, we will mute you. And so just make sure that your microphone is muted. With that, Bob, I'm going to pray and I'm going to turn it over to you. Okay, Bob?
Please.
Father, thank you for Bob Dull. Thank you for his ministry. Thank you for what you are doing in him and through him. We pray for wherever we are as we talk about this key topic about the economy as Christ followers, how that affects us personally, our giving, but also our churches and organizations that we lead. Help us to steward that well. And thank you for all that you do. And also, Lord, we give this up to you. In Christ we pray. Amen. Hey, before I actually have Bob start, let me actually just thank some of our partners. Number one, Together LA, through the leadership of Brandon Petrie. Brandon, thank you for always hosting these conversations. Bob, it was almost about a year ago that you actually were in Pasadena speaking live to the folks over in LA. And so the Growth Center under Northern Seminary, through the leadership of Dr. Bill Shield. Bill has always been a supporter of everything we're doing at the Growth Center. He helped launch the Growth Center. Thank you. Ron Blue Trust and John Yukawa. John, thank you always for your partnership and the ministry and the work of Ron Blue Trust. Chris Lesnar, Project World Impact, and also New Canaan Society over in Wheaton, Illinois. Chris is an entrepreneur. Chris has done so much for the kingdom over in Wheaton. Thank you for New Canaan Society in Wheaton, as well as Project World Impact. With that, Mr. Bob Dull, I turn it over to you.
Thank you, Mr. Tommy Lee, and hi, everybody. It's a privilege and a pleasure. As you surmise from the introduction, I've done these 10 predictions for quite a number of years. It's just a vehicle to share, particularly in the early parts of the year, views on the economy and markets. As you heard in Tommy's introduction, I'm a large cap US equity manager. So my lens is the US stock market. So if you're in an asset class different from stocks, I will comment a bit, but not much. If you're in geographies outside the US, I will comment a bit, but not much. I leave those expertise points to others and try to focus again from that US large cap lens. So I'll obviously touch on the building blocks for an investment outlook, which is the economy and earnings and the like. And many of these predictions will deal with the markets in particular. So following up on what Tommy said, all of us recognize that the assets that are entrusted to us, whether it's personally or what we have purview over, are not ours, they're God's. We are stewards of what he's given us. And I say to my kids and my wife all the time, you know, if this was really my money, who cares what I do with it? But it's because it's God's money. All of a sudden, the responsibility, the obligation, and the opportunity just grows meaningfully. So with that in view, let me take you through this. I have one slide of history, and that is take your eye back, if you could, to almost a year ago. I will never forget, as long as I live, how the expectations for 2020 global GDP, the broadest measure of economic growth for planet Earth, in early March, up 3%. And by mid-April, no, minus 3%. That 6% swing is the biggest swing in history over any time period, let alone a long month. Amazing. The unanticipated coronavirus crisis changed absolutely everything. In fact, for the first time in these 30, 35 years I've been doing these predictions, I issued a second set last year. When the world changed so radically, in April, I said to my colleagues, you know what? We're going to get a lot wrong this year because we didn't anticipate this recession and this crisis. Therefore, let's be helpful to investors and put out a second set. Now, we've had graders who have evaluated us over the years, and we've told them, you know, the ones we issued on December 31st, they're the ones we need to be held accountable to. But for the sake of trying to help investors, we came out with a second set. I don't have to go into the details, but as of December 31st, you see some of the carnage on the right-hand half of this slide, what occurred as a result of that, of the onset of that crisis as we turn the economy off. So with that in view, here's my summary slide for these 10 predictions, again, from the lens of the US stock market. I think it's going to be a great year for the economy and earnings, and a good year for the stock market. Why a great year for the economy and earnings? We're going to reopen the economy. We did some of that during the back half of 2020, as you know, but there's still a lot of stuff that is shut down and shut down hard. Did you know that Americans, skip the rest of the world for a moment, it'd be a much bigger number, but Americans saved $1.5 trillion above normal in calendar 2020. Not savings they wanted to do, savings they were forced to do. That came from three sources. One, the government mailed them some checks. Two, there were a lot of people, you may be one of them, who said, you know, I'd like to go do this and that and the other thing, but I can't, it's shut. So you can't spend that money. And three, and you might be one of these, I'm scared. I'm going to stay home. I'm going to stay under the covers because it's not safe out there. As the virus continues to move, as the vaccines continue to proliferate, we're going to get some significant opening of the economy, restoration of confidence. It won't be a straight line. It'll happen over time in the months in front of us. And some of that $1.5 trillion will get spent. That will create an amazing tailwind to the economy. So, great economy, great earnings. Why only a good stock market? My view is that what comes with this strong economy and earnings is modestly higher interest rates and inflation. And if you know anything about the stock market, you know the value of the stock market or any individual stock is simply the earnings of the company or the market as a whole multiplied by the multiple we put on it, the price earnings ratio. And PE ratios, as you see in the right-hand half of this slide, are at the high end of history, 96th percentile. With modestly higher interest rates and inflation, my guess is these PEs end the year a little lower than where they started, negating to some degree the power of that positive tailwind. That's the story. Part of me wants to say, Tommy, there are any questions, but let me dive into the 10 predictions and provide some detail. Prediction one, U.S. real GDP increases at its fastest pace in 20 years. Now, we released these on December 31st, which means I had to have them in about December 15th, so we could put all the slides together, the marketing material, the press releases, and all that good stuff. We did not know on December 15th that the Democrats were going to win both seats in the Senate race in Georgia. And they did, which gave the Democrats 50 seats and the tie-breaking vote, which means the probability of yet another big stimulus package, which was probably 10 to 20% prior to that Georgia runoff, became that next day 70 or 80%. Now it's nearly 100%. And if $1.9 trillion of additional stimulus, we've hardly spent any of the $900 billion that was passed in late December. That extra almost $2 trillion, plus probably another economic package on top of it, is going to add many points to GDP. When we made this slide, we thought we'd have a shot at the best economy in 20 years, which takes us back to the year 2000. We guessed GDP would be 4 and a fraction. The consensus was at 3.8. I now think this will be the strongest US economic growth in 36 years, the strongest since 1984. GDP in this country is probably going to be between 5 and 7%. In the right-hand half of this slide, you see we're going to hit new all-time high GDP by the middle of the year. It says third quarter. I think it might actually happen in the second quarter, which means we will have erased the entire recession. Now, that doesn't mean every industry is back to where it was. It just means the economy overall is where it was. While there's some industries still in deep recession/depressions, there are other parts of the economy that have had a massive tailwind from COVID. Among the reasons we think it's going to be a strong economy are these 10, I call them building blocks. I won't insult your intelligence or take the time to go through them all, but let me just highlight a couple. Due to the lagged impact of the massive monetary and fiscal stimulus, which is still in the system, that's going to get our economy really booming. Who would have guessed before the recession was over, we'd enter a housing boom thanks to very low interest rates? Number 7, improve productivity. A lot of people and a lot of companies during COVID bought some technology to improve their productivity. And what does that do? That increases economic growth and earnings. Very powerful. Prediction 2, inflation approaches 2% as the 10-year Treasury yield reaches 1.5%. Again, these are all US reference points. When we put this out in December, these were consensus numbers for 2022. In other words, we thought we would achieve in 21 what most people thought we'd achieve in 2022. And as you see on this slide, courtesy of Strategic Resource Partners, the consensus expectation for interest rates at the end of this year, 10-year Treasury yields in the US was 1.2%. Our guess is above 1.5. Do you know where we closed today? 115, up from 93 basis points on December 31st. Now, we're not going to go up 22 basis points every month and a half, but we are going higher. Why? This time I have 15 reasons. Again, I won't read them all, but let me touch on a few. Let's start with the US Central Bank, the Fed. Most of you that are in touch with the markets know the Fed, not too many months ago, changed their policy. From a long-standing tolerating 2% as the inflation peak, they're now saying they want the inflation rate to average 2%, which means if it's running 1, it's got to run 3 for a while to average 2. The Fed is inviting, encouraging, and stimulating for higher inflation, and their wish will come true. Number 6, one of the best leading indicators for interest rates and inflation is the behavior of cyclical versus defensive stocks, and cyclicals in the last few months have far outperformed defensive stocks. Number 12, many countries, including the US, are spending a lot of money. That means they're going to have to finance it, and you might have to offer a little higher interest rate to get people to clear the supply that's going to be massive to finance those things, and so it goes. Now, for the uninitiated or not close to the markets, 2% 10-year treasury yield or inflation and 1.5% 10-year treasury yield are still low numbers. They're up from where we've been, but relative to history, they're still pretty low. Number 3, of all our predictions, this is the one that is most consensus. It is that the US dollar sinks to a 5-year low. While the dollar is a bit oversold and against certain currencies is having a little bit of a rally, we think the decline will resume on the back of deteriorating macroeconomic imbalances. In particular, the fall in the net national savings rate and the rise in the current account deficit. And let me inject here a broader set of statements that really encompass all these predictions and speak to the world that as I see it. So remember, last March, we turned the economy off. And when we did, the policymakers said, the economy has a flat tire. Now, when you and I get a flat tire, what do we have to do? We have to reflate it. We have to inject air to reflate that tire. Same thing here. When the economy gets deflated, it has to be reflated. You don't put air into it, you put money into it. And the first place that money, massive monetary and fiscal stimulus goes, is the financial markets. Why do you think interest rates plummeted last year and bond prices went straight up? It's because of all this reflation activity. 10-year treasury yields got down to 37 basis points, unheard of. Stocks, why did PE ratios on stocks go straight up even as earnings were collapsing through the floor? The answer is reflation. The money was going into the financial markets. At some point, that money begins to, and it's happening, revert to the real economy. It's harder to get it there, but eventually it goes there. Why do I say all that? Because a reminder, the United States is the least cyclical, the most defensive economy and stock market in the world. And so when you think about the last decade, almost every one of the years, economic growth was so-so, mediocre, disappointing. Occasionally it was okay, but it was weakish. That's why the US economy, the US currency, and the US stock market outperformed the rest of the world. Think with me, if this reflation happens and the economy of the globe lifts, what's going to happen? The cyclical areas will do better. And so the US will, in some sense, pass the baton for economic growth, currency, and markets to the rest of the world. That's an important point underlying all these predictions. Number 4, stocks reach a new high for the 12th consecutive year, but to repeat, fail to keep pace with strong earnings growth. We've already had a new high. When we update this to include 2021, it will be the 12th year where during the course of the year, the market made a new high. Unprecedented strength. But we think stocks, to repeat, won't keep up with earnings. Now, when we went through this analysis in mid-December, we thought earnings, middle of the slide, would be up 21%. 8 from revenues, 12 from margin improvement, 1 from buybacks, 21%. My guess is, again, with that $2 trillion stimulus package added on to what was expected then, earnings growth this year is going to be more like plus 25 to plus 30. Our target for the S&P, 3950, which will make it a good year. Number 5, hopefully consistent with what I've said before, this is an asset mix prediction. We think when the year is said and done, the order of finish will be stocks first, cash second, bonds third, especially treasury and sovereigns. If so, it'll be the first year in 8 that happened, and only the third year and the last 20 that it happened. It won't take much for stocks to beat cash. Stocks already yield more than cash. So technically, the stock market doesn't have to do anything to have a higher return than cash. For cash to beat bonds, treasuries just have to move up a couple of ticks, which they did at the opening trade on the first Monday of the new year. If you own a US Treasury bond and most other sovereign bonds around the world, year to date, you are losing money. And if interest rates continue to go higher, you're going to lose a little more money. Number 6. Now I'm going to get in the weeds a little bit. Apologies for the generalists out there. But as interesting as the economy and earnings in the stock market are, what's far more interesting in my vantage point is what's happening inside the markets. To make that point, I take on this slide a period from roughly Labor Day of last year, early September, to Thanksgiving, late November. That nearly 3-month period witnessed the stock market, the S&P 500, returning, as you can see, two-thirds of the way down the slide, identically zero. It went up and down and sideways and went nowhere. But during that nearly 3-month period, look what happened. High beta stocks were up 20%, small cap stocks up 14%, industrials up 10%, Japan up 10%, emerging markets 9%, etc. Now, if the market's unchanged and a bunch of stuff goes up, something else has to go down. What went down was the biggest sector by far in the United States stock market, technology, down 5.5%, the NASDAQ 100 down 4%, Treasury bonds down 3%. Now, with that 3-month period in view, let me take you to a 10-year period. The 10 years ended December 31st, where, as you know, if you know much about the markets at all, look at that 10-year row, growth stocks clean the clock of value stocks. Big stocks beat small stocks. U.S. stocks beat non-U.S. stocks. Why? The whole reflation story I mentioned before. Mediocre growth, U.S. more defensive, growth beating value, large, all consistent. Our view is that baton is slowly getting passed. Now, that doesn't mean you run out and sell all your U.S. large cap growth stocks. It just means make sure you're complementing it with the other side of the story, if you will. Sectors, 2 preferences, healthcare and financials over the other 9. Healthcare is we call it a GARP group, growth at a reasonable price. Some growth, some value. Healthcare has good fundamentals. The stocks are pretty cheap. They're pretty high quality. The biggest risk with healthcare is legislation on drug pricing. We'll keep an eye on that. Our favorite cyclical area are the financials. They seem to have died over the last mostly decade, came to life late last year. More in those stocks, in our view. As the economy improves, we'll get more loan growth. As the yield curve steepens, better net interest margins, and the stocks, despite their recent run, are still pretty cheap. Number 8, I spend most of my time talking to financial advisors and other institutional investors, primarily, not exclusively, but primarily in the United States. And whether I'm here in the US or overseas talking to a bond investor, a stock investor, I think the most consistent question I've gotten over the last 5 or 6 years is, Bob, what about the debt and the deficits of the United States? And my comment is, yes, we are borrowing from the future, but it does not matter yet, capital Y-E-T. First of all, this slide shows that in the US, federal debt held by the public as a percentage of GDP will cross 100% this year, moving to the highest level we've ever seen before, post-World War II. And sadly, probably moving on to higher highs. So why doesn't this matter? The answer is the black line on this slide. As fast as the debt and the deficits have moved up, interest rates have fallen faster, such that interest expense as a percentage of the federal budget or as a percentage of the US economy has actually fallen. That's why nobody's talking about it. This will become an issue, sadly, eventually, if we do nothing about it, a big issue, but for the moment, it does not matter. Number 9, the US-China Cold War continues, but the conversation becomes a bit quieter and more multilateral. As you undoubtedly know, Joe Biden, the new president, has said he's going to try to get our allies in the US on the same page to attempt to stand up to China, different from President Trump's approach, which was more unilateral. My view is unilateral, multilateral, who's in the White House, what party, who's in the House, who's in the Senate, really doesn't matter. This is a big deal and going to last for some time and does have massive investment implications. In fact, as you see in blue, my view is China remains by far the #1 national security threat to the United States. Beijing has made it no secret. They intend to dominate the US and the planet economically, technologically, and militarily. Last I checked, the US was #1 in most of those areas. And as a result, there's going to be a battle here. Let's hope this war stays cold and never becomes hot. Keep your eye on this space. Finally, number 10 is always a political prediction. There is no election this year, so we're mentioning policy. Our view is, despite polarization, I should have put that in red and in capital letters. You all know the US is as polarized probably as it's ever been. Despite that, some more moderate voices, along with President Biden and Senator McConnell, will get some compromise legislation done. I believe because the House is nearly 50-50 and the Senate is nearly 50-50, the moderates of both parties in the middle, in both chambers, have the power. And they will decide what gets passed and what doesn't get passed. I also need to mention that Joe Biden and Mitch McConnell are friends. They spent decades together in the Senate. And I hope we hear that the two of them have a meal from time to time with nobody else in the room. I know what the dialogue will be. Mr. President, if you would only do this, we'd come along. And the president saying that to Mitch McConnell, hey, Mitch, what do I need to do to get you guys on board? And I think we'll get some stuff done. I make a list of 10 items here. I say possible compromises, roughly 1 in 3 chance for each. As a matter of fact, some of these have better than a 50% chance. Some are only 1 in 10. But I do think, as I've said at the outset, we're going to get another stimulus package. I suspect before the year's over, we'll have another bill. There'll be some infrastructure spending. We're going to have a tax increase, not the $4 trillion proposed by the Democratic platform and the additional $6 trillion of spending. It'll be more modest than that. It'll still be a big number, don't get me wrong, but not those big numbers that markets were so concerned about. Remember, the US stock market went down a lot last September. It went down another 7% the week before the election. It was concerned about the big blue wave, the right-hand half of this slide. That unlikely to happen. So 3 or 4 more slides, and then I'll, Tommy, turn this back to you for questions. Conclusions, hopefully consistent with what I said. Let me go through them. 1, the cyclical economic and earnings outlook has improved markedly. But number 2, the vaccine rollout has to happen at a reasonable pace. It's not been a straight line. It won't be a straight line, but vaccines are accelerating. 3, inflation and interest rates are moving higher. The debate is not direction, it's pace. 4, stocks are likely to go up this year, but less than earnings. 5, within fixed income, credit, spread, corporate, even municipals where tax conditions make sense, are preferred to sovereigns and treasuries. 6, the path of least resistance for the dollar is lower. 7, commodity prices likely to move irregularly higher. Caution, they've had a head of steam. They're entitled to a rest and may pull back. My longer term preference is for industrial commodities over precious metals, but I like both. 8, because of its size and growth rate, China remains by far the biggest driver of global growth. 9, my intermediate term concern is that central bankers and fiscal authorities overstay their reflationary efforts and invite an unwanted inflation. And number 10, because valuation levels for public markets, stocks and bonds, are at pretty high levels, we are likely over the next 5 to 10 years get much inferior returns than we witnessed in the last 5 to 10 years. Key risks, I'll leave the risks for the Q&A. So what do you do? Well, depends if you agree with all I've said so far. If you do, I think the what to do's are obvious. 1, longer term, expect lower returns. Focus more on alpha, less on beta. What I own rather than my asset class may matter more than it's mattered in a while. Within equities, own a little more high quality value, a little less expensive growth. Diversification, which everybody preaches, actually has not worked all that well much of the last decade, is probably something to pay attention to now. 5, back to equities, focus on earnings and cash flow, not valuation expansion. 6, keep an eagle eye on inflation. And 7, because of mediocre long-term returns, consider some absolute return strategies to complement your market exposures. One more slide. Let me end with this one, Tommy. Secular trends that were in place prior to COVID accelerated during COVID, and will continue long after we forget how to spell coronavirus. They are deglobalization, digitization, and online shopping. To me, everything else is up for grabs. What do I mean? Well, I remember, some of you will as well, when you think about it, 9/11. The world has changed. Books, papers, articles, speeches. Within 2 or 3 years, almost everything reverted back to normal. The only thing of substance that changed is you can't go to the airport 30 minutes before your plane and make the plane. You got to go earlier. Most other things reverted back to normal. And I think in large measure, that's going to happen again. It's going to take time, but this notion, I'll exaggerate to make the point, that everybody's going to work from home forever, everybody's moving out of the cities, totally misses it. Cities have advantages, they will come back, and a lot of us will gravitate back to offices. So Tommy, I could have gone on for hours. Perhaps some think I already did. So let me stop and see if there are any questions.
You got it, Bob. I'm actually going to stop your share screen so that we can see your great looking face real fast. Actually, can you stop your sharing your screen, Bob?
Sure.
There you are. Hey, Bob, a bunch of questions come your way. You did these predictions around mid-December. What changes have you seen in the last couple of weeks, in the last month and a half?
Well, I mentioned the biggest one in my view, and that is the Democrats capturing the Senate in the United States, paving the way for a bunch more spending in 2021 than we thought we would get coming into the year. That's the biggest. And that means more growth, more earnings, and probably modestly higher inflation interest rates compared to what we've been before. Point one. Point two, earnings in the fourth quarter all over the globe have been absolutely astronomical. In the United States, earnings growth for the fourth quarter versus expectations on January 1st, 12 points better. That's a record. Now, for those close to the markets, we'll quickly point out the companies that did the best relative to expectations on the revenue line and the earnings line, actually their stocks have gone down a little bit. So the expectations were very high.
Got it. Comment on the situation with AMC as well as GameStop.
Oh, how many hours do I have? Let me start with this. That this was a surprise to anybody is the biggest surprise to me. I mean, think about it. What do we have? Again, I'll speak to the U.S., my common frame of reference and the place I pretend to know something about. Zero interest rates, essentially free money. Checks mailed to people who have had full incomes all the way through. Now, I'm sympathetic to those who lost their job and providing government aid. But those people who have a salary had it all the way through and are being mailed checks on top of it. They don't use that money. They can't use that money because their favorite place is closed. So they have excess money. And because they can't do these things, they have excess time on their hands. Guess what they're doing? Let me roll the dice in the stock market and let me call my friends and see if we can have a little fun. That's exactly what's happened. They picked on, GameStop is the first poster child, company that had a huge short position. Let's see if we can squeeze the shorts. As the dust settles, there are many individuals who made a ton of money. There are many individuals who lost a ton of money. There are many hedge funds who made a ton of money. There are many hedge funds who lost a ton of money. This is not the individual won and the hedge fund lost. It's all across the board. And my guess is we're going to see more of it. What I hope we don't get is onerous legislation that comes in and creates less liquidity in markets, which raises the cost of capital, which puts a damper on economic growth. So no surprise at all, Tommy. The surprise it didn't happen sooner.
Got it. So Bob, in some sense, what I'm hearing you say is the situation of GameStop AMC is not a one and done. We may see similar situations that may happen in the future with other stocks that people pick.
Yeah, are we going to see it to the degree of GameStop? I doubt it, but not out of the question. I mean, there are probably 15, 20 stocks that you can see increase volume, short squeeze. I have some long short money. I'm short some American Airlines. And there were a couple of days when, that stock went up 25%, not because they had any good news, because the shorts were squeezing it. And we thought the stock's not worth what it's selling for. We shorted some more, and the stock came right back on down. They even went to the silver market for a day or two and tried to squeeze the silver market, and that price went up a bunch. It's crazy.
Bob, I know there are a bunch of financial folks here on this, but I'm actually more addressing some of the younger ones. I'm addressing some of the pastors. If they see or hear rumors of something similar to GameStop in the future, is this something that they just need to jump and just buy it? Or would you say to some of those pastors or younger guys, just hold off a little bit?
So I mean, you heard my American Airlines. We're kind of close to that. And when that stock shot up, we said we didn't think it was worth it was selling for before the squeeze. So that goes up 25, 30%. We shorted some more. I've not done my homework on GameStop, but if GameStop was worth 50 before they got involved, and you wake up one day and it's selling at 400, it's probably a good time to sell that stock, not buy it and try to speculate with everybody else. Now, I am arguing from the standpoint of an investor who believes that fundamentals and earnings and valuation are important. In the short term, that's not necessarily the case. What we witnessed is in the short term, supply and demand is what drove the price of that stock, regardless of fundamentals and valuation. So you have to be prepared for that kind of thing. No one said the stock market in the short run is something that's going to sell at fair price. Stocks spend half their time above fair value and half their time below fair value.
Got it. Bob, talk a little bit and share your thoughts about Bitcoin, cryptocurrency.
So I don't know if you've heard me say this before, Tommy, but I remember when my son Bobby, who called me not that many years ago and said, "Dad, do you own any Bitcoin?" And I said, "Bobby, what's Bitcoin? I've never heard of it before." I don't know how many years ago it was. I've done a little studying since then. Look, I believe cryptocurrency is a technology that does have legs. I'm not sure we know yet exactly who the winners and the losers are. Reputable, really in-depth analysis around these sorts of things is now happening, so it's easier to get educated. And look, in fact, I read, it was either yesterday or early this morning, I can't remember, an article that compared the US dollar with Bitcoin and gold in terms of the reserve currency in the world and the characteristics that you need, and it went through. And at the end of the day, the dollar, despite our attempt at just being just cratering that currency, is still a better store of value than those other two. So watch crypto, watch Bitcoin. I guess Tesla's, if it wasn't before, Tesla has legitimized Bitcoin.
Especially
Tesla made more money in Bitcoin recently than they have been making selling cars.
Especially when Elon Musk and promoting Dodge, which is currently at 6 cents at this point right here. Hey, Bob, here's a follow-up question on Bitcoin. Is Bitcoin, Ethereum, all of that, are they slowly being accepted from corporations because of a distrust in a dollar or paper currency?
Yeah, so the more popular, I'll stick with Bitcoin, gets, the more legitimacy it has in the marketplace. I come back to, look, the US dollar is to date the reserve currency of the world. And I'd be the first to say, as an ugly American, the US is doing nothing to earn the right to be the reserve currency of the world. But every other currency has more trouble than ours. I mean, the euro, are you kidding? It's an experiment that still hasn't worked. The yen, very unlikely with the demographic deterioration and decline in the population. The yuan is just not big enough and broad enough and deep enough to be the reserve currency of the world. So it goes to, well, the dollar limps across the finish line as the reserve currency of the world, despite all these other things. Now, I'm not going to say for the young people on this call that in your lifetime, you might not see some change. Maybe there'll be a package of currency some way, somehow. In fact, a lot of stuff is already sold as a mix of currencies, but I don't see anytime soon the dollar not finishing by limping across the finish line as the reserve currency of the world.
Yeah. Hey, talk a little bit about the stimulus plan that the president is proposing. Will the stimulus plan hurt the country and the economy as the Republicans say it does? Or do we need the stimulus plan to save small businesses and the communities within our country?
So I'm going to try not to sound political in my answer. So let me first comment on the $900 billion package that was passed in late December, and then the 1.9 proposed. My view is, and I already intimated that in my comment earlier, that if this could be aimed at the people, individuals, and businesses that are really hurting, that would have far better impact than the very broad swath of people it's being aimed at. I mean, we have 3 kids. You know that, Tommy. Two of them are young, they're working, they have not lost their jobs, they're not making much money, and so they're under the threshold, and they're getting checks. Their income is higher today than it was before COVID. Not because they got a raise, because Uncle Sam says, here's some money. I think it needs to be targeted, and I would say that about both plans. The $900 billion passed at the end of December, most of it is not spent yet. I would argue 2/3 of it's probably not spent. And now we're talking on top of that, another 1.9 trillion. There are economists on both sides of the aisle that are saying it's too much and it's going to invite reflation too quickly and inflation and overheat our economy. You know, when you're in crisis, it's nice to have some money to spend to help those who need it. But let's do it in a logical way would be my point of view. I always say, back to the budget deficit in the United States and many other countries, what you want to do is in good times run a surplus. So in the bad times, you can run a deficit. You can't run a deficit when things are great and then run a bigger deficit when things are bad and expect things to work out well over the long term. Sorry for my diatribe.
No problem. Hey, Bob, one person, you and I were in Pasadena probably about a year ago to this time. One person said to this, let me see. When we were in Pasadena, you mentioned that unemployment is down, but the discrepancy between the rich and poor continues to grow. Is that still the situation today more than ever?
So I'd say a few things. Number one, when we were a year ago, the unemployment rate in the United States was the lowest it's been in 50 years overall. It was the lowest ever in history among most minorities. So a lot of progress had been made. And yet the gap between, I'll say, the have and the have-nots was still pretty big. Now, it had narrowed in the 3 years up to the end of 2019, in other words, before COVID. The gain in income at the lower levels was higher than the gain in income at the higher levels. So slowly, belatedly, and not fast enough, we were beginning to make some progress to close that gap. COVID has actually pushed it faster in the other direction. I mean, think about it. Lower paid blue collar workers have been hurt more than higher paid white collar workers. Most white collar workers can do their job, not all of them, most can do their job from home. Most blue collar workers have to go to their place of work and they can't. So yeah, COVID has pushed us back in terms of any kind of trying to narrow disparities.
You got it. Well, hey, here's another thing. You could tell that I'm not going to be experiencing this particular question. Irene, who you know from Sydney, Australia, says, what is your view on tech valuations? Should the risk profile come down considering the long-term sectoral trends?
Hi, Irene. It's great to hear you're on. So a lot of people have, as you know, because you know this area, compared the tech stocks today to the tech stocks in 1999 into year 2000. Things are very different. I remember, some of you will remember also, in the tech stock peak time, we talked about tech valuations as price to clicks or price to eyeballs. We couldn't talk about price to revenues, price to earnings, because they didn't have any earnings and some of them didn't have any sales. They were all concepts. So the bubble was much bigger then. I'm not saying there aren't pockets of overvaluation in high tech land, especially if interest rates and inflation move up a little bit. There is some risk there. But to say this is the same, not that you're saying that, Irene, to say this is the same as it was then, I think is clearly missing it. I didn't spend a lot of time on the sectors. You saw 2 we like, 2 we don't. In the US, we have 11 sectors. So that's kind of, as a result, 7 sectors were more neutral on. Tech's in that mix. So my portfolios today, I have tech, but I have a little less high PE tech than I did 6 months ago, and a little more value tech than I did 6 months ago.
Hey, Bob, should the average individual investor continue to look at domestic US stocks in the US, or should we look at foreign stocks in 2021?
Both. Look, as I said earlier, if you had all your money in US over the last 10 years, and it was in big, large cap growth stocks, you were pounding your chest, say, I'm a genius, because those stocks were the cat's meow. In my view, you don't want to sell all of them, but you want to peel them back some and put some money in the areas that perhaps you've neglected. Value is doing, but year to date, small stocks are several hundred basis points ahead of big stocks. I think there's probably more of that to come. And as I mentioned, the international markets, especially in my view, the emerging markets, deserve some attention.
You got it. Another one, what impact is the shutdown in the Keystone going to have on the 2021 economy? Will the US lose its energy independence this year?
We won't lose it that fast. What we're going to lose as a result of not doing that is a lot of potential jobs. Tens of thousands of jobs won't happen. Now, if you're environmentally conscious, you might say that's worth it. That's the debate. Although most of my energy expert friends tell me that the environmental friendliness around that pipeline was incredible, and therefore canceling is probably not a smart idea. It actually hurts Canada more than it does the United States, and it eventually will take the edge off the huge energy independence that the United States now has.
Got it. Bob, actually a pastor asked this question. I only have so much savings besides my 401k, Roth IRA. So should I invest in crypto or should I put it into a Vanguard account?
So I'm assuming that money is not to be lost. So I would take the slightly safer bet, which is probably the Vanguard index fund to crypto. You put it in crypto, you may look a lot smarter than putting it in an index fund, but you could look a lot dumber and a lot more quickly, a lot more volatility there. So I take the safe route, and I wouldn't put it all in an index fund either. Index funds are heavily geared toward those big cap, high PE stocks, and I think that some of those averages will lag the average stock. It's already happened. The average stock is 740 basis points ahead of the S&P 500 already this year.
You mentioned that China is the biggest driver of global growth. Is that good or bad? And also, Bob, how do we think as Christ followers think about this missionally as we look at global missions as well too?
Well, I'd start by saying it's just arithmetic because China is so big and their growth rate is so high compared to the rest of the world. The multiplication of those two numbers, if somebody correct me if they know differently, but I think last year China accounted for a little more than half of the growth of the GDP in the entire planet. And that's happened around half in a number of years simply because their size and their growth rate. So that's just something that, is a fact. Now, is it good or bad? The Economist magazine in July wrote the following: the West no longer trusts China, but has to find a way to do business with it because of its size. So it's the yin and the yang. Can't ignore it because of its size practically, but has to be wary. Missionally, I mean, some of you know far better than me. There's some places on this planet where the Church of Jesus Christ is growing like a weed. China's one of them. I mean, I think we all know, either directly or indirectly, where there is the most persecution tends to be where the church grows the fastest. Parts of the Middle East, parts of Africa, parts of Asia, including lots of places in China. And so missionally, it's a great thing that's happening.
Yeah. Ministry leader asked is, donation-wise, as the world, not only the U.S., other parts of the world, starts getting the vaccine and seemingly the economy starts running, will donations come back to normal? Or do you think that there will be a fear over other strands of the vaccine that will continue to keep the economy hostage?
So I can only speak to the U.S. with any authority and not much there. Donations in 2020 were way above what people thought they would be and way above 2019. Because people, hearts were tugged as a result of the needs that grew out of COVID, one. Two, they had extra money because they couldn't spend it and or the government was mailing them checks. They were very generous. Most of the nonprofits that I'm associated with got scared, middle of last year, early last year, cut back their expenditures, expecting donations to be down. In many cases, donations went up. In fact, the two that I spent board time on today, both had record years of contributions in 2020. So my guess and my fear is, as the economy comes back to normal and people can spend more money and may have less time to reflect on, giving money away, 21 could be the tough year.
Yeah. And wouldn't you say a lot of times ministries cut their travel, and in many cases that travel really decreased a lot of the expenses in many places?
No question. Expenses went down. That's one of the reasons. And look, I think those of you who are have the responsibility, getting new donors in this environment's tough, but getting your loyal donors to step up where there's a need, there are a lot of hearts that are willing to do that.
Got it. Is there a possibility that the world's transactional currency moves away from the US dollar?
Well, we discussed that a few minutes ago. Obviously, there's that possibility. And if the U.S. continues to do what it's doing, not to count our blessings that we are the reserve currency of the world, and don't protect it, we'll eventually lose that right. But to what other currency, I'm not sure. So I'm going to use the phrase one more time. The dollar continues to limp across the finish line as the reserve currency of the world.
You got it. All right, Bob, here's the technical questions. I hope I'm saying this right. Are SPACs, S-P-A-C-S, I have no idea what it is, causing bubble type valuations in the equity markets? Are SPACs here to stay, and will we see more regulations in the area?
Okay. So SPACs in the vernacular are just another way to do an IPO. Simpler, less regulation, more speed to market. And SPACs are very, very popular. Yeah, I think there's some speculation going on, no question about it. You mean I can't wait for an IPO? Do a SPAC, and I'm in. How big a check do you need? There's a lot of that going on, so I think it's to be watched carefully. My guess is, well, back up. SPACs require a lot less paperwork and oversight and regulatory dot the I, cross the T than IPOs do. And so there's probably some speculation going on.
Got it. Do you see, at least for the US side, do you think this new stimulus plan will pass, or do you foresee any issues?
The current, the 1.9
Yep.
Joe Biden, I think it will pass. They've obviously moved to reconciliation, which means you don't need 60 votes. You only need 50 in the Senate. The Democrats have 50. I believe that it will pass with It may pass exactly along party lines, which would be really, really sad. It happened before. That's how the Republicans got the tax cut under Donald Trump the first time around. You know, we need less polarization, more bipartisanship, but we're not going to get this time. I do believe the bill will pass.
Can you talk a little bit more about or reinforce your thought on bonds losing money?
Yeah. So if you look at a long-term chart of interest rates back to, let's say, 1980, which is about the time interest rates peaked in most places. So call it the last 40 years. Interest rates in the last 40 years have gone mostly in one direction, down. There have been some periods where they ticked up a little bit, but when interest rates go down, bond prices go up. I mean, you know, I tease my bond friends. Bonds are easy. When rates go up, prices go down and vice versa. That's all you have to know. And if interest rates have been going down for 40 years, it means bonds have been going up for 40 years. Believing that interest rates, to repeat, which got in the 10-year Treasury yield, which is the benchmark for much of the world, 37 basis points last March, 93 basis points on December 31st, today 113 or something close to that. Interest rates are slowly moving higher. And when rates move up, bond prices go down. You lose money in bonds.
You got it.
It's arithmetic, nothing fancier.
Couple more questions. With lots of concern over the airline industry, the hospitality industry, and its global impact, what is the potential impact on the recovery in 2021?
Yeah, so first a little history. Travel, leisure, entertainment. I'm going to throw in bricks and mortar retailers. Those industries are in some form of recession/depression. Those industries employ about 14 million Americans. By contrast, over on the other side, swaths of technology, healthcare, home building, online shopping, those industries employ 42 million Americans, triple the number in the first group. This first group was hurt big time by COVID. This second group was helped big time by COVID. What's my point? That's why the economy has gone like this, because there are more industries benefiting from COVID than getting hurt. Now, to your question, it is those first group of industries, because they're still in deep recessions, that are the ones that will benefit the most when the economy does finally open up, vaccines are successful, people get more confidence, and they take this $1.5 trillion burning a hole in their pockets and spend a little money. I mean, which one of us doesn't want to go out to a restaurant to eat with our friends or our family? Which one of us doesn't want to think about getting on a plane? I'm speaking to some other people on this call, I'm sure. I normally travel about 70% of the time. I've been on 3 airplanes in the last year. It's a very different world. Now, I hope I don't go back to 70%, but something between 0 and 70 could be a happy medium. Those industries will be the lion's share of the pickup in our economy if we're going to have a 5 to 7% growth rate.
Bobby, you mentioned you were on 2 board meetings for Christian ministries today. For ministry leaders, put your board hat on. What's your encouragement as a board member if you were to counsel some of these ministry leaders or church leaders who are sitting here on this call?
Have a vision. Have your vision consistent. Make sure you have a plan to execute your vision. Communicate it and communicate it again. If you do that, you will find people who identify with your cause and want to be part of it. I know that sounds so simple, but sometimes we so overcomplicate these things.
You got it. Donors, put your donor hat for those who are sitting here. All of us are donors. What's your word of encouragement as we head into 2021? What's your word of encouragement to us as donors?
So, some basic biblical truths. I think I said this one up front. It's not our money, it's God's. 2, if it really is God's money, the question is never how much should I give? It's how much should I keep? The rest is God's. If that doesn't revolutionize your thoughts about generosity, stewardship, and giving, I don't know what will. And maybe another point related to that is, remember, we're on this planet for this long, and we're in eternity this long. I think people who have trouble parting with their money and giving often think this is their home and they got to maximize what's here. And I'm going to steal from my friend Randy Alcorn. You can't take it with you, but you can send it on ahead. So in all that, my encouragement is give your money away. If you've had your money in the stock market, you've done a whole lot better in the last, 10 years than you thought you were going to do. Take that overage at a minimum and find some great causes and give it to the Lord's work.
Got it. Bob, you actually, for those who are in Jakarta and even for the Gross, and you recorded a seminar on leadership. You have not read the latest one that our friend Michael Ramsden, our RZIM, came and issued some of their findings on Ravi. Wasn't very, very good, but not even talking about what happened. Was share a little bit words as we talk about leadership, the inner life of a leader, and reflections upon that.
Yeah, I have been in conversation with and praying with Michael Ramsden, president of RZIM, and the news is grim, as I think some of you probably know. But that aside, Tommy, I remember you and I had the conversation. All of us, especially leaders, the farther up you are in an organization, generally, the more lonely you are and the more accountability you need. I say to everybody who listens, I say this to my son all the time, Bobby, have some accountability partners. Bobby, have somebodies who can ask you anything. I'm happy as your father to be that person. And at times I have been that person for him, who's going to ask you anything and invite them to ask anything. We can set up all kinds of rules around things, but our evil minds and Satan working in us can do all kinds of things. We all need protection. We all need guardrails. We all need accountability, and we all need a strong relationship with our God.
You got it.
And I say, I love the work of RZIM. They have some amazing apologists. Anybody that knows that organization knows that despite Ravi's feet of clay, he trained some unbelievable ambassadors for the gospel.
Yeah. And eventually, for those who are sitting here, we will have a sit-down conversation soon when Michael Ramsden's ready with Bob, sitting down and talking with Michael Ramsden about all of this stuff that's going on. Any last words as we wrap up, Bob? Because I know it's 10 o'clock and you get up at 4 o'clock in the morning here, my friend.
Maybe I'll sleep to 4:05 tomorrow. Hey, it's been a pleasure talking to you. I hope this has been helpful in some way, shape, or form. I apologize if I got too technical somewhere along the way. It's always great to talk to fellow believers. I think we all know that to whom much is given, much is required. And so as we appropriate that wherever we are in the world, whatever our lot in life, there are a lot of people we can help and a lot of causes we can be part of. And if taking care of your money and investing it well is part of that, have the bigger picture in mind.
Well, we will save this recording, upload on YouTube, send you guys a copy of it. Thank you to our friends, Together LA, the Growth Center, John Yukawa and the Ronald Blue Trust, Resource Global, Chris Lesnar and Project World Impact, as well as the New Canaan Society. And so, Bob, thank you so much for just being there. Thank you to our friends from the US, Jakarta, Australia, Singapore, Malaysia, and Nairobi. Thank you for all those who have joined us today. So good night, everyone. Bob, we'll talk soon and have a good night.
Adios.
Have a good night, everyone.